Why do most investors limit themselves to just one type of compounding when there are 4 proven strategies that could multiply their wealth much faster? The painful truth? You're probably leaving millions on the table right now without even knowing it. Look, here's what's actually happening. While 99% of investors are stuck thinking compound interest is just one thing, there are actually 4 completely different compounding strategies. And the wealthy? They're quietly using all 4 while everyone else is missing out on life-changing wealth. The difference is staggering. If I told you that combining these 4 strategies could turn $100,000 into $58 million over time, compared to the measly few hundred thousand you'd get with just basic compounding, that gap should terrify you. That's the difference between retiring comfortably and retiring wealthy beyond your wildest dreams. This is exactly why some people's portfolios crawl along at 7% while others are seeing 15%, 20%, or even higher returns year after year. It's not because they're smarter or luckier, they just know something you don't. And after analyzing thousands of successful portfolios and studying how the ultra-wealthy actually build their fortunes, I've identified exactly what that something is. Today, I'm going to break down all 4 compounding strategies that most investors never even know exist. We'll start with the obvious one that everyone uses, then dive deep into the 3 hidden strategies that separate the wealthy from everyone else. By the end of this video, you'll
have a complete roadmap to multiply your wealth using methods most people will never discover. But here's where it gets interesting. The 4th strategy is so powerful that when combined with the other 3, it creates what I call a compounding multiplier effect. I can't reveal what it is just yet, but I promise you've never heard of it before, and it's going to completely change how you think about building wealth. So here's what I want you to do. Drop a comment right now and tell me which compounding strategies you've actually tried. Are you one of the 99% using just one method, or have you discovered more? And if you're ready to learn all 4 strategies that could completely transform your wealth building, smash that like button because we're about to dive deep. Let's start with the one everyone knows, dividend reinvestment. But I promise you, what comes after this will blow your mind.
All right, so dividend reinvestment, or DRIP as we call it. This is probably what you think of when you hear compounding, right? But here's where most people mess up. They'll buy dividend stocks, get those quarterly payments, and then the cash just sits there in their account, doing absolutely nothing. It's like having a money-making machine that keeps breaking down because you forgot to plug it back in. DRIP automatically takes those dividends and buys more shares. More shares mean bigger dividends next time. Bigger dividends buy even more shares. See where this is going? Let me show you something crazy. Let's say you have $100,000 to invest. You put $50,000 into SCHD. That's a solid dividend ETF yielding about 3.71%, paying quarterly. The other $50,000 goes into realty income, yielding 5.62% but paying monthly. Now here's the kicker. After 10 years, your SCHD grows to $155,000 and realty income hits $176,000. Total, $231,000. Not bad, but wait. After 20 years, SCHD jumps to $482,000. Realty income rockets to $620,000. Now you're at $1.1 million. But the real magic happens at year 30. SCHD reaches $1.5 million. Realty income hits $2.2 million. Your $100,000 became $3.7 million just by letting those dividends do their thing. And notice something interesting? Realty income, with its monthly dividends, actually outperformed SCHD even though it had lower total returns. That's the power of compounding frequency. The more often you compound, the faster your money grows. But here's the thing, DRIP is just the appetizer. Strategy number 2 is where things get really interesting. Time in the market. This one sounds simple, but it's probably the hardest for most people to actually do. Why? Because it requires you to do nothing. And let's be honest, doing nothing when the market's crashing feels impossible. But here's what the data shows. Missing just the 10 best trading days over a 20-year period can cut your returns in half. Half. Think about that. You're trying to be smart, getting out when things look bad, but you end up missing the recovery days that make all the difference. Let me paint you a picture with the same $100,000, but this time we're thinking long-term growth. You put $70,000 into VO. That's a broad market ETF with about 12.82% annualized returns. The remaining $30,000? You put it into a single company that you research and believe in long-term. Let's say Apple, which has averaged 29.8% annual. After 10 years, your VO position grows to $232,000. Apple? Well, that $30,000 is now worth $360,000. You're sitting at almost $600,000 total. But here's where time really shows its power. After 20 years, VO reaches $770,000. But Apple? That $30,000 is now worth $5.55 million. Your total portfolio is $6.32 million. And if you had the discipline to hold for 30 years, VO grows to $2.55 million, but Apple explodes to $55.5 million. Your total? $58 million from a $100,000 start. Now, I'm not saying put everything in Apple. That's incredibly risky. But the principle is clear. Exceptional companies held for long periods can create life-changing wealth. And even the boring broad market ETF turned $70,000 into $2.55 million. The key is staying in through the 2008 crash, through COVID, through whatever comes next. Time in the market beats timing the market every single time. But what if you don't have $100,000 sitting around right now? That's where strategy 3 comes in. Here's the beautiful thing about compounding contributions. You don't need to be rich to get rich. You just need to be consistent. Most people think they need a huge lump sum to start investing. Wrong. Some of the wealthiest people I know built their fortunes $500 at a time, month after month, year after year. This is called dollar cost averaging, and it's actually a compounding strategy most people completely miss. You're not just compounding returns, you're compounding your contributions too. Here's how it works. Let's say you start with $100,000 like our previous examples, but this time you add $1,000 every single month. You put $60,000 initially into DGRO. That's a dividend growth ETF averaging 11.6% returns. The other $40,000 goes into Procter & Gamble, a dividend aristocrat. Every month you add $600 to DGRO and $400 to P&G rain or shine, bull market or bear market. You just keep adding. After 10 years, you've invested $220,000 total. Your original $100,000 plus $120,000 in contributions. But your portfolio? It's worth $279,000. Not mind-blowing yet, but you're building momentum. After 20 years, you've put in $340,000 total. Your portfolio is now worth $1.95 million. That's nearly 6 times your contributions. But here's the magic. After 30 years, you've contributed $460,000 total. Your portfolio? $4.46 million. You've turned less than $500,000 in contributions into almost $4.5 million. The beauty of this strategy is that it removes emotion from investing. Market down 20%? Great. Your $1,000 buys more shares. Market up 30%? Awesome. Your existing shares are worth more. You win either way. Plus, you're smoothing out all that market volatility. Sometimes you buy high, sometimes you buy low, but over time, you get a decent average price. This is how regular people build extraordinary wealth, not through some get-rich-quick scheme, but through boring, consistent investing. But there's one more strategy that can supercharge all of this. Now, this is where we separate the smart money from everyone else. Dividend growth compounding. Most people focus on high dividend yields. They see a stock paying 8%, 10%, even 12%, and they think they've hit the jackpot. But here's what they miss. High yields often mean the dividend is about to get cut. And when that happens, your safe income investment becomes a wealth destroyer. Smart investors focus on dividend growth instead, companies that increase their dividends every single year. These are called dividend aristocrats, and they've been raising their payouts for 25 plus years straight. Through recessions, market crashes, everything. Why does this matter? Because of inflation. If you're getting the same dividend payment for 30 years, your purchasing power is getting destroyed. But if that dividend grows 8 to 10% annually, you're not just keeping up with inflation, you're crushing it. Let me show you what I mean. Same $100,000 start. You put $60,000 into NOBL. That's an ETF of dividend aristocrats averaging 9.5% total returns. The other $40,000 goes into Microsoft, which has grown its dividend by 10.35% annually while delivering 27.95% total returns. After 10 years, NOBL is worth $148,000 and Microsoft hits $432,000. You're at $580,000 total. But here's the kicker. Your annual dividend income has grown from $1,200 to $8,500. That's a 600% increase in passive income. After 20 years, NOBL reaches $366,000. Microsoft explodes to $4.68 million. Your total portfolio is $5.04 million, and you're collecting $35,000 annually in dividends. That's more than many people make in their jobs. But the 30-year picture is insane. NOBL grows to $894,000, Microsoft to $50.4 million. Your total, $51.3 million. And you're collecting $280,000 per year in dividends alone. Think about that. $280,000 in annual passive income from a $100,000 start. That's not just wealth, that's financial freedom. The dividend growth strategy gives you the best of both worlds, growing capital and growing income. Your money is working harder every single year. But here's where it gets really crazy. What if you didn't have to choose? What if you could use all 4 strategies together? Because here's the secret the ultra-wealthy know. These strategies aren't competing with each other. They're complementary. They multiply each other's effects. Imagine this. You start with dividend growth stocks that automatically reinvest their growing dividends. You hold them for decades through all market conditions, and you consistently add more money every month to compound your contributions. You're getting DRIP, compounding on growing dividends, time and market compounding on appreciating assets, dollar cost averaging to smooth volatility and build positions. Dividend growth to create rising passive income. This is how you turn $100,000 into millions. This is how regular people retire as millionaires. This is how generational wealth gets built. And here's a bonus tip that could save you hundreds of thousands in taxes. Do all of this inside tax-advantaged accounts. Roth IRAs, 401ks, whatever your country offers, let that money grow completely tax-free for decades. The math is clear. The strategies work. The only question is, will you actually do it? Look, I've just shown you 4 proven ways to multiply your wealth faster than 99% of investors know how to do. But information without action is just entertainment. So here's what I want you to do right now. In the comments below, tell me which of these 4 strategies you're going to start with. Are you going to set up DRIP on your dividend stocks? Commit to staying invested for the long haul? Start dollar cost averaging $500 a month? Or focus on dividend growth companies? Pick one, start there, master it, then add the others. And if this video opened your eyes to something you didn't know before, hit that like button and subscribe, because I'm going to keep showing you exactly how the wealthy build and protect their money. Remember, you don't need to be rich to start, you just need to start to get rich. Time and consistency will do the rest. See you in the next one.